Gold has been bouncing around above $2,000 all the way since mid-December. And as the Lunar New Year is approaching, let's have a look at gold's and precious metals outlook into February and March. For an outlook on energy, grains, and a lot of other assets, join us at myfinancesteacher.org, where our data-driven approach guides every step of our journey towards maximizing profits. As usual, talking about precious metals, talking about gold, let me start with the US dollar. This is the US dollar in front of us. We have daily as well as intermediate cycles. Daily cycles usually last for around a couple of months. The ongoing daily cycle has been going on for 27 days so far, and it's also the beginning of a new intermediate cycle, by the way. So as the daily cycles usually last for around a couple of months, and we're on day 27 today, dollar isn't likely to go significantly higher from here, perhaps a bit of a test of the mid-December highs that would coincide with the 50% retracement of this intermediate cycle decline. That's a retracement from the top in early October. Perhaps a test of this 50 fib as well as the mid-December highs before dropping down into the short-term daily cycle low. And as it's a new intermediate cycle, this decline into the daily cycle low isn't likely to be extremely strong before second daily cycle starts with a bit of a rally towards the top of the intermediate cycle. With these likely dollar moves in mind, looking at gold, what's likely to happen over the next short term is perhaps a bit of a bounce into a new daily cycle while dollar drops into the short-term daily cycle low, followed by another decline down into a more discernible intermediate cycle low for gold. Perhaps not a significant low, maybe a bit of a break below this 200-day moving average to scare everybody out before the markets push into a new intermediate cycle rally, leaving a lot of the inexperienced traders behind. That's what markets usually do. If you don't want to be left behind, make sure to join us at myfinancesteacher.org. Next, moving on from gold itself, let's look at the relative ratio of gold miners to gold price. This is GDX over gold price going all the way back into that financial crisis in 2008. Since the top in precious metals around 2011, we've seen this bear market in commodities all the way into late 2015. Since the end of that bear market though, this ratio of gold miners to gold price has been signaling relatively good buys somewhere around the levels 0.12 to 0.14. Clearly a buying opportunity at the end of that bear market, another clear buying opportunity here in August 2018 after that grueling decline in precious metals, which I've mentioned in some of my previous videos. A very nice buying opportunity over here at the pandemic lows, and at the end of that recent decline into another grueling long-term decline into the end of that intermediate cycle, late 2022. More recently, this ratio of gold miners to gold price has already entered this zone, the zone of anywhere around 0.012 to 0.14. But looking at this weekly 14-week RSI, we haven't come that close to being oversold on this ratio. So, as I mentioned on gold price itself, while there'll clearly be short-term bounces while dollar drops down into the daily cycle low sometime over the next few weeks, the intermediate outlook is still down into that intermediate cycle low, which is likely going to be marked by this RSI on the ratio of miners to gold price approaching much closer to that oversold level. Hence a bit of a potential signal here on this ratio. Next, moving on to market sentiment. As they say, the time to buy is when blood is flowing on the streets. That's when everybody is pessimistic. Nobody wants to hold this asset. And looking at the actual data, that's when this optimism index is at least below the level of 50 and perhaps much closer to that level of 30. Within the last few weeks, back in December, this optimism index did top out around the level of 66. So while nobody knows the future, what I know, gold might just spike up to 2100 tomorrow, which isn't likely at all though. So while nobody knows the future, it's quite likely that the intermediate cycle has already topped. Meaning that again, the next buying opportunity at the intermediate cycle low is likely going to be accompanied by this optimism index, anywhere below the level of 50, perhaps even below the level of 40. Zooming out a little bit, even these intermediate fluctuations fit into these longer term cycles where intermediate cycle lows come with the optimism index below the level of 50 anywhere around the 2020 and 2021. These are relatively good times in precious metals, while in relatively harder times, intermediate cycle lows comes with the optimism index well under the level of 40, perhaps closer to that level of 30, this green line, that's all the way through 2018-2009, for example. So again, these intermediate cycle lows themselves make up a longer term fluctuations from hard times as in 2018-2019 to good times as in 2020-2021, hard times again in 2022, with another grueling decline down into October 2023. But in the longer term, I think gold is moving into good times again. Remember though, even in the good times, intermediate cycle lows usually come with this optimism index at least below the level of 50. So similarly to what I mentioned in my previous video on the 16th of January, patience is still advised in precious metals. By the way, hit the like under this video and subscribe to the channel. Remember those notification bells. Next, moving on to COT reports, commitment of traders. We have smart money, the red line, that's commercials, versus the dumb money, that's the speculators, the green line. We see that the smart money positions are rising into these intermediate cycle lows. Looking at what's been going on over the last few weeks, we see that positions of the commercials has just started rising, but it's far from any peaks. What sort of peaks would you expect into that intermediate cycle low? Well, looking at 2021, for example, even with these mild intermediate cycle lows, relatively mild declines into those lows, the peaks on these commercials positions were anywhere around the negative 180,000. At the moment though, the position is at a negative 207,000. So for the intermediate cycle low, we should at least cross this 200,000 level for the commercials positions to be negative below 200,000. That's around negative 180,000. Perhaps even closer to zero for a more severe intermediate cycle decline. And talking about those severe declines, perhaps into February and March, looking at seasonality, since 2015, that's since the end of that bear market in commodities, while seasonality suggests that there is a pretty good chance for gold price to continue rallying into late February, ultimately, again, within the intermediate outlook, we usually do see gold price dropping right after the Lunar New Year down through the second half of February and all the way down into March. This sort of seasonal March decline was especially severe during the pandemic low in 2020. Even if you remove the 2020 from your seasonality, we still do see a general decline in gold price again down into that mid-March. And what you'd also see here is that if you remove 2020, a rally from late January into mid-February is not that significant. That again aligns with our expectations of perhaps a mild bounce once dollar is dropping down temporarily into the short-term daily cycle low, followed by a decline down into that intermediate cycle low when the optimism index is down through the floor, everybody is scared, gold price would be poking below the 200-day moving average, inexperienced traders throwing in the towel, while you, having joined us at My Finance Teacher, would be taking advantage of that buying opportunity. For much more details, join us at myfinancesteacher.org by simply clicking this button, Join Now. Have a terrific Tuesday. Bye-bye.